My name is Steve Gribben, and thank you for joining me in this Glassbox strategy session. My goal today is to give you a few very valuable pieces of information that can help you lower your cost of capital as a public company. But before we get into any of the particular strategies I'm going to discuss, I'd like to talk about how your cost of capital is defined. Your cost of capital is made up of three basic components. First, the interest you pay on your loans. Second, the per share price at which you issue your shares. And third, and most often overlooked, your cost of capital is defined by what I like to call your financial liability overhang. Financial liability overhang basically encompasses all of your exposure to future increases in the cost of debt and equity on money you've already raised. So for example, what is it going to cost if your convertible preferred converts at a discount to the market? If your convertible debt converts at an even lower discount? If the anti-dilution clause in your prior stock or note issuance is triggered? What if the default penalty in your bridge loan is triggered because something outside of your control took place? The list of items that I could bundle into this financial liability overhang category goes on and on. Raising capital in the small cap space can be insanely expensive because of all the costs I just described. And if you don't know how to control your financial liability overhang, your company will literally be eaten alive by wolves, like shredded to pieces, no joke. In my time as a securities attorney, I found there is one basic difference between small cap companies that survive and thrive and small cap companies that fail. Essentially, companies with a long-term capital formation plan outperform those without such a plan. Companies that take control of the capital formation process win. So what does a long-term capital formation plan look like? Well, it involves three fundamental components. Number one, setting in place a prudent strategy to raise capital on a continuous basis so that your reserves grow and new business opportunities can be seized at a moment's notice when they arise. Number two, setting in place a prudent strategy for project-based financing so that you can target projects that fit within your financial capabilities. And number three, setting in place a prudent strategy to finance unexpected one-time expenses so that you are not thrown to the wolves when such events arise. So again, plan for continuous capital raising, plan for project financing, and plan for emergency financing for those unexpected events. If you develop and apply a strategy that touches on all three of these points, you should literally be able to cut your cost of capital by 3x or more. It may be hard to believe, but if you develop this sort of game plan, you can completely avoid the toxic convertible financing that plagues so much of the small cap market. You probably won't be able to eliminate your entire liability overhang, but you will greatly reduce it. My firm works with all types of small cap issuers, and we have been able to help many companies design and implement effective strategies to take control of the capital raising process. There's no need to build your company simply to feed it to the wolves. If you're interested in learning more about how we can help you develop a long-term capital formation plan, and specifically what legal and financing structures may be available given your particular circumstances, we would love to connect. Please feel free to contact me via email at info@glassboxlaw.com or just through our website via one of our inquiry forms at glassboxlaw.com. Thank you.